A 401k is going to be one of our most commonly used investment toolboxes where we hold our investment tools, stocks, bonds, mutual fund, etc. First of all, let's not get overwhelmed with the name 401k. It's literally a line in the tax code that just makes them legal. And there's a lot of information out there about 401ks that you can find on the internet, but I'm trying to boil this down to give you what you really need to understand. Most importantly, every time you look at your 401k balance, let's just say it says there's $100,000 in there. That's not quite accurate because there's going to be several different types of dollars that make up the $100,000. And we usually don't spell out all the little pieces that make up that balance. And it matters because each different type of dollar has a little bit of a different characteristic and it affects you a little bit differently. At one level, most of the time when you see your account balance, it's going to be divided up between employer dollars. I call them ER dollars. That's money that the employer, your company, puts in on your behalf. And then you have the employee dollars, EE dollars. That's going to be money that you put in as an employee. And it's important to understand that distinction because EE dollars are always yours. You put that dollar, you put $100 in there and you want to take that out the next day, you can do that. It's not an issue. Now, the employer dollars, ER dollars, they're going to generally have a different set of rules associated with them. For example, if an employer is giving you money, they probably don't want to give you money for you to up and leave the next day. So there's typically going to be some sort of what we call a vesting schedule. That means you have to stay there for a certain amount of years. And as you stay there for more and more years, a higher percentage of those ER dollars now become vested or become yours. But that vesting schedule never applies to your EE dollars because you put that in yourself. So that first classification is going to be the difference between employee and employer dollars. One of the other key things to understand is that in addition to that, they're likely going to be divided into pre-tax or Roth dollars. Fortunately, with employer contributions, ER contributions, those are always going to be in a pre-tax basis. What that means is that the money that goes into the account, nobody's going to pay taxes on that in the year that it goes in. But the IRS has a rule. Every dollar has to be taxed once in its life. So if money isn't going to be taxed in year one, then when you decide to take that money out later, it's going to be taxed then. Fortunately for employer dollars, they're always going to be pre-tax. So it's easy to remember. If it's an employer dollar, it's always going to be pre-tax. And so you're always going to pay taxes on it when you take it out later. The employee side, EE dollars, becomes a little interesting. It used to be that employee dollars were always pre-tax as well. But recently, it's become kind of a standard practice to add what's called a Roth option. So we're going to flip this tax concept on its head when we talk about Roth. When you make a Roth contribution, you are going to pay income taxes in the year that you make that contribution. If you put in $100 into your 401k as an employee contribution, as a Roth employee contribution, you are going to pay income tax on $100. But the rule is the IRS is going to make you pay taxes one time and one time only. So as that investment, as that $100 is invested and hopefully grows into a much higher amount, you're not going to pay income taxes on any of that growth because that was already taxed up front. It only gets taxed one time. And this is really key because, again, we pay taxes one time. And what a 401k ultimately is, you're planting seeds as investments, hoping to reap the benefit of the harvest down the line. You pay taxes one time, and taxes are always going to be based on what something's actually worth. What's worth more, the seeds or the harvest? Clearly the harvest. The harvest is worth a lot more than the seeds. So if you can choose and you only have to pay taxes one time, it probably makes more sense to pay taxes on the smaller value as opposed to the higher value, because that means less taxes. So to put this all in summary, a 401k is going to have multiple types of dollars. It's going to have employee dollars, which are always yours, and it's going to have employer dollars, which usually are going to be subject to some sort of requirement for you to stay at that company a couple of years before you can access that. You can choose to do a pre-tax option, which means you're not paying taxes on the seeds and you are paying taxes on the harvest. Or you can choose a Roth option generally, which allows you to pay taxes on the seeds, on the contributions that they go in, meaning the harvest comes out tax-free. And what's good about what we just talked about is we can take those rules and apply it to virtually every employer-sponsored retirement plan out there. There's going to be in any other type of account, 403b, 457, there's going to be this breakdown between employee in employer dollars, same rules are going to apply. And there's likely going to be the breakdown between pre tax and Roth, and the same rules are going to apply. You're only taxed one time.